It's not Bitcoin that will be the currency of the future, but something built on its principles. The first principle being decentralization, which means no government or bank has control over it. It's peer-to-peer, person-to-person without any middlemen. But while we can imagine a world where we have complete control over our money and how it is used, there are other concepts at play here that might actually be more important than that. Let me explain. If you ask anyone what Bitcoin is, they'll tell you it's a digital currency. If you ask them what it's used for, they'll probably say buying drugs on the dark web, even though that's not true. Just like how 99% of credit card transactions aren't used for illegal activities. But that's what the media focuses on because it makes headlines. And then if you ask them why the price is so volatile, they'll say because people speculate on it, even though most assets are at least somewhat tied to their underlying value. Bitcoin isn't. There's nothing backing it except for the belief that it'll have value tomorrow. Because of this, it doesn't make sense as a currency since currencies need to stay stable. You would want to hold on to your cash savings and then go buy something 2 years later, only to find out that now your $1,000 is worth half of what it was before. So you had to work twice as hard for the same thing. Of course, this doesn't apply to the assets whose values grow with inflation like real estate, which is why holding cash is dangerous in times of high inflation. But those assets require significant capital investment. You can't just start buying houses, flipping them and doing that at scale. So Bitcoin being a failure as a currency does not mean that its underlying technology, the blockchain, is a failure. Let's dive into what that really is and how it'll change the world. The word blockchain is confusingly used to describe both the data structure itself and the protocols that use it. It is similar to how people refer to YouTube videos and the platform that hosts them as Facebook or Instagram, even though those are technically just client applications that run on top of the social graph, which is the real underlying technology. So, let's clear up this confusion right away. A blockchain is just a database that stores data in blocks, which are linked together in a chain. This is actually pretty simple and not that special. In fact, Google uses a similar technique to rank websites based on The reason blockchains are special is that they're append-only, meaning once data is written into a block, it cannot be removed. Additionally, all participants in the network get a copy of the data, and anyone can verify its validity. In theory, this prevents double spending where you could spend the same money twice. Let me demonstrate. Imagine Alice wants to send $100 to Bob, and we store the transaction data in blocks on a blockchain. First, the transaction is broadcast to the entire network. Then miners, which are just computers that run the protocol, will bundle it together with other transactions into a block. Before adding it to the blockchain, they'll use computing power to solve a complex math equation. The difficulty of the equation is set such that on average only one miner will solve it. This ensures decentralization because if multiple miners found the answer at the same time, they would have to keep competing until there's only one winner. This competition also ensures security because malicious actors would have to control 51% of the network's computing power to manipulate the system, which is expensive and difficult. Once a miner solves the equation, they get rewarded by minting new currency. This is how new currency is created. After the block is confirmed by the network, Alice will receive a coin with the amount of 100 minus the fee she paid to the miner. Then Bob receives the coin from Alice. The record of this transaction is stored in multiple places across the entire network and cannot be removed. So, this way, we know that Alice didn't double spend her money. While this example uses cryptocurrency, the same concept can be applied to voting records, property titles, and more. In fact, companies like HSBC are already using it to track diamonds to prevent money laundering. Now that we know what blockchain is, let's talk about how it's being used today and how that'll evolve into the future. Most people have heard of cryptocurrencies like Bitcoin, but did you know that there are more than 10,000 different types? Most people think of Ethereum as just a currency, but in reality, it has more of a programmable platform that lets developers build applications on top of it. For example, Uniswap is a popular application built on Ethereum that lets users trade one token for another without needing a middleman like a bank. Instead of stockpiling wealth, the programmers who built Uniswap received tokens when the app was first launched, which have since grown in value by hundreds of thousands of percentage points. Applications like this are part of the larger concept of decentralized finance, or DeFi for short. In addition to removing middlemen, which leads to lower fees, DeFi applications can also automate many processes. For example, MakerDAO is a decentralized bank that issues loans without human intervention. Instead, it uses smart contracts, which are just pieces of code that automatically enforce the terms of an agreement. If the borrower doesn't repay their loan, the lender is automatically repaid from the borrower's collateral. Sounds simple, right? Well, banks don't do anything that you can't do yourself. They just do it on a larger scale and more efficiently. They maintain reserves for bad debt, meaning if enough borrowers default, the lenders will still get repaid. But it's much easier for them to raise funds and operate with less overhead, meaning they can lend money for lower fees. In fact, this technology can theoretically replace almost any kind of institution that provides a service. For example, NFT stands for non-fungible token, meaning it's unique and cannot be replicated. Since these are just pieces of data stored on a blockchain, they can serve as proof of ownership for digital and physical assets. Today they're most commonly used for artwork, but they can be used for almost anything. For example, every luxury handbag designer could create NFTs that prove authenticity and allow resale. So if you were to buy a bag for $2,000 and it appreciates in value because it becomes rare, you can sell that appreciation just like crypto. This way sellers do UNF to deal with counterfeit products diluting their brand, and buyers can trust that the product is authentic without having to rely on the seller. Even if they wanted to, they couldn't replicate it because all the data on the blockchain is public. You can check every transaction and see exactly where the asset came from and how it was modified. Now, while this sounds great, there are some problems with it. For example, if you want to change the color of your digital artwork, you would have to reach out to the artist or the platform where it was minted, whereas today you can simply save it locally, and no one would know the difference. The blockchain would show that the image has been modified, but it won't prevent you from doing so. The same is true for websites. If we put all the data on a blockchain, you could modify local copies of the page, but the blockchain would provide a single source of truth that documents the original version. Now you might be wondering what all this has to do with the future of currency. Well, the truth is that no one really knows what that'll look like, but some things are certain. First, major world governments are not going to allow cryptocurrencies that threaten their monetary policy to exist. Just ask El Salvador. Their adoption of Bitcoin as legal tender caused extreme volatility in the currency's value, making it practically unusable. Second, governments will continue to experiment with central bank digital currencies, CBDCs for short. China is already well underway with theirs, and others are following closely. While these are often referred to as crypto, they actually more like digital representations of fiat currency that are controlled by the bank rather than being decentralized. This gives them some of the benefits of cryptocurrencies, like reduced overhead and easier international transfers, while mitigating the risks, like extreme volatility. However, CBDCs do pose the risk of giving governments too much control over their citizens' spending habits. They can even tailor ads to you based on your purchases. So it is possible that a CBDC will be used in combination with a private digital currency that you can opt into for increased privacy. Either way, there will likely not be a single winner in this race. There are simply too many different use cases for different kinds of currencies. I wouldn't be surprised if there are dozens, if not hundreds of them, all existing side by side. As the lines between physical and digital assets continue to blur, blockchains will become a critical infrastructure for managing all of humanity's wealth. That's why it is so important to understand the technology behind it all, instead of getting distracted by the latest cryptocurrency pump and dump schemes. Thanks for watching till the end, and I'll see you in the next one. Thanks for watching till the end, and I'll see you in the next one.